This is a video in the continuing series on the inputs to the theoretical valuation formula. In this video, we will be discussing the cost of capital. Cost of capital is used in the valuation calculation, but it is also important to think about it as an overall measure of the riskiness of the investment. Technically, the cost of capital represents the average cost of capital that includes both equity and debt, and is expressed by the weighted average cost of capital, known as WACC. Since we are discussing stock valuation, cost of capital in this video refers to just the equity portion, which is technically known as the cost of equity. But don't be confused. Later in the video, when discussing cost of capital, recall it actually referring to the cost of equity. But first off, let's talk about cost of capital as it relates to the formula. Well, when you go off to the Polaris website, in this case we're looking at Walgreens, the ticker page for Walgreens, the focus primarily of moving the input parameters around from the growth slider to the other input values of future shares, profit margin, price earnings ratio, and even the cost of capital, and then the length of time that you spend in the first phase, or called the competitive advantage period. All those input parameters go into resulting in this practical investment return. Then you, as an investor, if you decide that that's a reasonable and appropriate rate of return for you to target, then you save off the plan. I've already saved a plan earlier for Walgreens, so let's go look at a previously saved. You can see here I saved off a target return of 12%, the price at the time that I saved it off, and then the plan maintains these thresholds for buying more, holding, or selling off what I have based on the target return. So if we look at the this graph that's been shown in other videos, is that you start off at some price, you target some investment return, which is this purple line, and then you move towards the eventual future price that you've targeted. So the slope of this line is essentially this target return, and that's why the endpoints of the beginning price and the ending future price is really what is important and influences the path that you expect the price to take over the next 5 years. Now, if you want to bring it back to a present value, that's the orange line. You notice here that depending on the discount factor that you use, you'll bring it back to a certain price. This gives you a way to compare the average prices line with the average valuation line, showing how they will completely mean revert in 5 years. The closer the cost of equity is to the investment return, the quicker the reversion. So the other values that go into the input formula outside of cost of capital are really the suggested values that you input values that you focus on, because that's what's really going to impact your practical investment return. So if the cost of capital doesn't factor into the practical investment return that gets calculated, the question comes up from why do we need to even look at the cost of capital? Well, let's go look at the formula real quick and just make sure you can see that in the formula that's used by Polaris is here, and the cost of capital is just simply in the denominator, and discounted back for the whatever 5 years is typically Y, and it brings back to the present. So beyond that, I mean, getting $86.59 and then a proprietary algorithm that results in a practical valuation of $83.61. Besides that, then what's the purpose of cost of capital? Particularly if it doesn't end up changing the practical investment return. Well, the main reason that you want to consider cost of capital is not for the present value, but for just risk assessment. And the value that is shown on the Polaris website, in this case for Walgreens, is 8%. That's a historical derived number based on the price history, the volatility of price history. We'll get in more into that later in the video. But it is worthwhile for you as an investor to consider what is the riskiness of the investment, And not just from a historical standpoint, but more importantly, from a future looking standpoint. And yes, you could say, well, I think the past is going to continue in the future. And you could choose to use the 8% number, which again is the default number used to discount to get present value. But it is better to consider the likely future. If an average stock in the S&P 500 has a historical cost of capital around 7 to 7.5%, when you see something like 8%, that means that based on historical price volatility, Walgreens has historically been a little more volatile than the overall market. Is that something that you want to go forward with? And so instead of calculating it like it is historically and shown on the Polaris site, it's worthwhile to think of it just from a categorization. Would you put Walgreens in a category of, higher risk than the overall market, lower than the overall market? And then later on in the video, we'll get more into how you give more thought to where you would eventually land. Now, as you give that some thought, let's say you end up saying, well, I think maybe Walgreens will be a little more risky than the overall market. And I think it's going to be more like 10% as it relates to the overall market versus 7.5%. Well, you might ask yourself, well, then what does that do to kind of the risk-return profile of Walgreens? Does that make it still a worthwhile investment? Well, until you get up to 12.3% as a future categorization of cost of capital, the present value of this higher cost of capital is always going to be greater than the price up to the point you get to 12.3%. Once you get over 12.3%, then the present value is going to start dropping below the current price, and that's going to be an indicator that the risk return profile is probably not adequate enough to take on the investment, even though it could have a fairly high return. It's all about the risk, how much risk is associated with that return. So I caution anybody using the Polaris website to just strictly focus on the practical investment return. You need to consider, once you've decided you've got an adequate target for investment return, categorize future risk and then consider whether the risk is above or below 12.3%, and then you'll have the risk return profile. Also keep in mind this trade-off between risk and return. And this graph shows the classic conceptual view of taking on more risk and getting more return for that risk. But what's often forgotten about this risk-return trade-off is that any point on the line is really an average of the investment at that represents that risk-return trade-off. That the investment itself typically has a distribution of returns, and you're looking at the average. So you got to remember that you could end up with a return below the average or above the average. And typically, as you get in higher risky investments that have higher and higher returns, the distribution of the return for that level of risk become more and more discrete. And think of the extreme case like a lottery. It's either you win the lottery or you lose the lottery. Or the risk associated with that is extremely high, and you don't get some payoff if you almost win. It's either you win or you lose. So keep that in mind, that the risk return is not just some linear relationship. More risk, more return. No, there's more risk. There's more possibility of a higher return, but there's also a distribution associated with that means that the higher risk also means more likely you're going to have discrete outcomes and either win or lose. Or another way to think about this risk of cost of capital is it really reflects kind of the angst or the pain as you as an investor will be going through, will have to endure over the next several years as you own the stock. That's because the stock will go up and down. It will not, stick to this purple line. It'll vary around the line, and how much of that variance can be seen in the investment plans as you look at, like here for Walgreens, this what the buy and the high and low range is, what the watch, the midpoint is 67.03 as of today, which is right around the current price, but it could go all the way down to 47.38. It could go all the way up to 90.50. That's quite a range, and you as an investor have got to come to grips with whether that's a level of angst that you're willing to deal with. Another way to think about it is this kind of your degree of belief as the stock moves away from the purple line. Will it eventually recover and come back towards the purple line? In other words, that's mean reversion. Do you believe in mean reversion, which is the Polaris website feels that on average 5 years out, most stocks will eventually mean revert to more historical averages. So it's really boiling down to whether you think you're being equitably compensated for the risk you're taking based on the targeted investment return. Now, another place the cost of capital comes into play is outside of this first 5 years, and then using it for discounting back to the present value of the future forecasted price, is in the price earnings ratio. So if we go out and look at the formula again, you notice that we do have a future PE, and as I discussed in the PE input video, bring that back up here briefly, is that the PE ratio can be thought of as mathematically as what I've shown here, and what you can do is divide both sides by your earnings, and you get a PE ratio that has a specific formula, and it involves cost of capital. But this is the cost of capital 5 years from now. It's a cost of capital that you assume is going to continue on in the mean reversion period, like I said, which is 5 years out. So it's a different cost of capital, but it is a different risk that you need to consider for a different time period. So cost of capital in the first 5 years is what I just discussed as relates to Walgreens and this 8%. And then you've got another place in when you're thinking through your valuation inputs where cost of capital comes into play, and that's in terms of the PE ratio, what the future PE is going to be in 5 years. So really the cost of capital boils down to here in the first 5 years is whether you believe that the target investment return is going to be achieved or not. The more risk that you assume, the less likely that investment return is going to be achieved. And if you go over 12.3% in terms of your perceived or categorization of risk, then it's advisable that you don't make an investment regardless of the practical return if there's that much risk associated with it. So if you want to get think through more about how you would come up with a categorization for future cost of capital, a way to think about that is this through a very well-known theory called the capital asset pricing model. And that model was created by William Sharpe back in 1964, but before him was Harry Markowitz, who came up with this idea that you can describe a stock investment through two main attributes: its potential return, and then also the riskiness of that return. And Harry Markowitz chose to use the historical price volatility as measured by the standard deviation as a way to measure that risk. William Sharpe came along a decade later and made it relative to some benchmark, primarily the S&P 500, and that relative risk is known as beta. And then the formula for calculating cost of capital is the risk-free rate, usually the 10-year Treasury bond rate that people use. And the equity risk premium is something that's beyond the scope of this video, but if you go out to Dr. Damodaran's site from New York University, he maintains a blog on equity risk premium and what he considers at any given time the appropriate equity risk premium to use in this kind of a calculation. So as you're thinking through how to categorize your cost of capital, you got to consider what's the likely beta going forward, what's the likely equity risk premium, risk free, all those things have to be considered to come up with a thoughtful categorization of future cost of capital. Now that is the exact formula that's used in the computation of the historical cost of capital. Here it's 8% for Walgreens. And the beta is looked up on a website. The equity risk premium is derived from Dr. DeModron's site, and then the current 10-year Treasury bill is looked up. Now, if you were to go out and try to replicate the calculated number, you could get a little frustrated because depending on which site you go to, you'll see different values for beta. The reason for that is that beta is a regression calculation that uses as input the index that it's being regressed against. Like I said earlier, typically the S&P 500, but also what factors in the calculation is the period. Is it for the last 3 years, for the last 5 years? And then the frequency. Are you sampling once a month, once a quarter? And then even within the sampling period, when are you sampling? If you're sampling every month, are you sampling the middle of the month, the beginning of the month? So a lot of detail in the calculation of that beta. And that led to McKinsey consulting firm came out several years ago with some rules of thumb to be used in beta calculation. They suggested that you go with 5 years and then use monthly sampling, and then also to use the S&P 500. Now it turns out that if you go out to Yahoo uses 3 years of monthly data, but if you go to Reuters and some of its other sites that use the Reuters data, it uses what McKinsey recommends, and that is 5 years of monthly data. So that's just some ways for you to think more deeply about the cost of capital. The last topic in this video addresses the question, why doesn't the competitive advantage period cost of capital factor into investment return calculations? And so I'm going to briefly go through that to close out the video. And the reason is that the formula that Polaris uses for calculating an investment return, which is shown here as the default investment return, is it takes the current price of the stock, and it solves for this future or this investment return such that the current valuation that's been derived for the stock, in this case I would say it's $86.59, cost of capital is historically is 8%, so doing some algebraic manipulation you end up with this relationship, and then you can solve for an investment return of 12.3%. Well, if we think about possibly modifying the cost of capital, if you were to modify it, instead of when you calculate valuation, instead of using a default cost of capital, you're going to use the user's cost of capital. So that means you'd factor out the default cost of capital and divide in the user's cost of capital, and that's the formula you end up with. Well, once you have that, you use the same formula for determining now the investor's or the user's investment return, and using the user's cost of capital, and then you end up with a similar formula for the investment rate of return. Well, what you notice though is that V hyphen is now the new valuation that you're assuming with the new cost of capital. We know what that relationship is, so we can substitute this back into the formula, do some algebraic manipulation, and you'll end up noticing that this new user investment return is identical to the default investment return. So the cost of capital didn't make any difference. But if you choose to go ahead and want to modify and see what the change would be to the present value of this future value of a stock that you're forecasting, the preferred way to do it, which you see me use in other videos, is the method where you alter the valuation. You take the current cost of capital divided by the user's cost of capital out to the 5th year to see what the modification in valuation would be. You would modify the sales growth slider till you see that valuation, see what the resulting practical valuation is, and then what the impact would be to your practical valuation. So in closing, regarding this video, is that cost of capital or cost of equity is not that important of an input value to the In fact, it doesn't come into play at all in terms of determining the practical investment return. It does come into play in determining present value, and present value is only interesting as it relates to the categorization of risk. Is if that present value drops below the current market price, then you're probably dealing with an investment that regardless of its investment return, has too much risk associated with it. So it's primarily cost of capital comes into play in this categorization, thinking through not just what the historical rate of cost of capital has been, but what do you think the cost of capital is going to be going forward, and then use some of those ideas that I went through to kind of think through that. And then as long as it stays below the target investment return, you probably got an equitable risk return trade-off in order to go forward with it. Now again, if you want to check whatever value you come up with, use the approach I just talked about in terms of modifying the valuation and move the sales growth slider, and you can see whether the current present value drops below the current price or not. Then if it does, that would not be an investment that would be advisable to continue. So practical return, primarily what Polaris website is about, but you do need to consider the riskiness of the return, whether you're equitably compensated by the return for the risk or the angst that you'll be going through as you own this stock. Okay, well, thanks for watching the video.